Audio Jungle.
What is Benjamin Graham's investment strategy? Graham was a value investor and contrarian. He distrusted market valuations and growth projections. He preferred to value a stock himself based on the company's tangible assets, debt levels, earnings, and dividends.
Benjamin Graham quotes about investing.
The word preferred does not add anything to the value of an issue. If a common stock has just as large earnings applicable to it and no greater deduction ahead of it, it must be more valuable than a similarly situated preferred because the common stock is entitled to all future earnings and the preferred only to a restricted portion thereof. The man who is sure improvement is coming can buy on the basis of current less favorable conditions, and thus derive the full benefit of the betterment if it materializes. It is important to make sure that one is not lured by rash enthusiasm into commitments at levels greatly above those soundly warranted by the financial setup and the earnings record. The stockholder wants both income and appreciation, but in general the more he gets of one the less he realizes of the other. All experienced investors know that earning power exerts a far more potent influence over stock prices than does property value. The worth of a business is measured not by what has been put into it, but by what can be taken out of it. Current earnings, future prospects, management, marketability are all factors more or less independent of assets which contribute their share to the intrinsic value. The analysis of security values is not an abstruse science. While in essence mathematical, it does not soar into the realms of calculus. In fact, it rarely gets as far as algebra. Quotations fluctuate constantly, reacting often illogically to all sorts of temporary and even trivial influences. There is a considerable tendency for common stock investors to do the greater part of their buying, both of good and bad securities, at high levels of the market. They are equally inclined to do the greater part of their selling at low levels of the market, a procedure which is not conducive to successful results. My own opinion is that the selection of individual securities is a matter partly of a special kind of judgment and insight, and partly of a good deal of security analysis training. In the stock market, facts are important, but emphasis is all important. Tradition, sentiment, vague generalizations, unsubstantiated rumors, can never be made the basis of sound investment or intelligent speculation. Now and then large profits are realized on no better foundation, merely proving that sometimes luck laughs at logic. In a speculative market, what counts is imagination and not analysts. It is easy, of course, to pick out good companies that are better than other companies. But that is not the same thing as picking out good stocks to buy at their current prices. If you have an opinion about the level of prices, it should be an opinion based upon your concept of the values of securities in relation to price, rather than on any prophecy or expectation of changes or of the continuance of a given moment. I am skeptical about stock market forecasting by anybody, and particularly by bankers. I don't think the objective of investment should ever be to take a risk in order to get a return. I think the objective of shrewd investment should be to find opportunities which offer a larger return than the average, combined with adequate safety. The only sound distinction in investment policies for one type of investor or another is based not on his financial position but on his financial competence and financial preparation. Please do not forget that as the common stock level advances, the advantages of common stocks appear to be more attractive and the basic need for owning them becomes more persuasive in everybody's reasoning. Yet in fact, common stocks undoubtedly become riskier as the price advances, and thus the risk increases as the widespread acceptance of common stock develops.
It may be a fair generalization to assert that the top levels of most normal bull markets are characterized by a tendency to equate stock risks with bond risks. Perhaps nothing is more indicative of the quality of a company's management than its accounting methods. Discrepancies, and hence opportunities, in securities originate most often when events move faster than quotations. I am convinced that an individual investor with sound principles, and soundly advised, can do distinctly better over the long pull than a large institution. If you can invest your money under fair conditions, in fact under attractive specific conditions, I think one certainly should do so even if the market should go down further and even if the securities you buy may also go down after you buy them. The successful purchase of growth stocks requires two rather obvious conditions: first, that their prospect of growth be realized, and, second, that the market has not already pretty well discounted these growth prospects. The trouble with stockholders, in my humble opinion, is that not enough of them are disgruntled. Speculation, I imagine, is a theme almost as popular as love, but in both cases most of the comments made are rather trite and not particularly helpful. Speculative operations are all concerned with changes in price. In some cases the emphasis is on price changes alone, and in other cases the emphasis is on changes in value which are expected to give rise to changes in price. The problem is not whether price changes should be disregarded, because clearly they should not be, but rather in what way can the investor and the security analyst deal intelligently with the price changes which take place.